Welcome back everyone here to Midnight Inside with a recap of all the news that you wanted to know, but you didn't hear because you were too busy. Let's go. So the Federal Reserve held interest rates steady again, and that's not shocking. But what is shocking? A rare internal dissent from inside the Fed. Yes, they're fighting in there quietly, like economists do. But this little crack in the wall might be a sign of something bigger, maybe even political influence. Let's unpack what's really going on and why it matters for you and your wallet. The Fed secession and internal dissent. So the Fed once again refused to cut interest rates. This would be for the 5th straight meeting. Despite earlier expectations of policy easing, this year, the real shocker, Dallas Fed President Larry Logan dissented, essentially saying, "Yeah, guys, why are we even discussing cuts?" That kind of internal disagreement is rare, and it raises questions. Now, is this dissent just economic disagreement, or is there political pressure leaking into the Fed's thinking? Trump is back in office, and he's been crystal clear. He wants low interest rates and less Jerome Powell. Powell's term ends in 2026, but the pressure is already mounting. But he's not caving up to Trump yet. He's on a hold firm, letting the economy cool. No pressure yet. Why Powell held rates? Let's get serious for a second. According to macro logic, the Fed held because core inflation is still sticky, especially in services. Powell sees that we're not back to 2% yet, and he's worried about declaring victory too soon. Also, there's a new tariff uncertainty, a strong job market, and a solid GDP. Basically, the Fed is telling the markets, no, you're not getting cheap money until we're sure inflation is taking a nap. And with housing and energy still contributing to inflation, yeah, no surprises there. Here's what Jerome Powell had to say at a press conference meeting.
A lot of lean in the markets, and not to mention out of the administration for a rate cut now in September. Is that expectation unrealistic at this point?
This is an intermeeting period when we'll get 2 full rounds of employment and inflation data before the time of the September meeting. We have made no decisions about September. We don't do that in advance. We'll be taking that information into consideration and all the other information we get as we make our decision at the September meeting.
Markets react, repricing the fantasy. After the announcement, the markets had a bit of a whoops moment. In June, traders expected 3 rate cuts, now maybe 1, at best 2 by the end of the year. It's like planning for a vacation and realizing your flight's delayed indefinitely. So yields on the 10-year note jumped. The dollar rebounded slightly and stocks got jittery. Let me remind you that when yields rises, it's supposed to suggest higher expectations for economy growth and inflation. Oh, and gold? It's just shilling. The point is, the market has repriced the rate path. So, no more dreams of easy money. Investors are now pricing in higher for longer, to put it simple. For simple minds like you. What it means for you as an investor. The financial and tax implications are clear. If rate cuts are delayed, borrowing stays expensive. That's bad for credits, mortgages, and yes, small business loans. The Fed can cut without risking on inflation rebound, so the dollar weakens, asset prices go crazy, and investors start running to gold, Bitcoin, real estate, anything except cash. Final thoughts. So here's the bottom line. The Fed didn't cut. One of their own said, "Don't even think about it." Markets panic. And Powell, he's stuck between inflation, politics, and one very angry president. If you're an investor, keep your portfolio diversified. Stay light on debt and be ready to pivot if cuts do come late this year. If you're just here for the drama, here's a picture you might like. Stay sharp, stay late. Like, subscribe, and I'll see you in the next one.